This new law kind of gets around that problem by allowing taxpayers up to $1,000 per person, so $2,000 for a couple filing jointly, to deduct their charitable contributions even if they are taking the standard deduction. So no longer is taking the standard deduction a deterrent or a disincentive for charitable giving.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Handsome & Weeble. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. We are joined again today by Helene Downs, a partner in our tax department. Thank you for coming back, Helene.
Sure, happy to be here.
So today we are talking about charitable gifting.
I'm looking forward to it, Clarissa. You know, charitable giving really starts from the heart, but thankfully there are some tax benefits that can come along with that.
Yes, so can you talk to us about the tax deductibility of charitable gifting?
So charitable contributions have to meet just a few pretty simple requirements to be potentially tax deductible. They need to be an irrevocable gift, so there can't be any element of retained control over the gift. They can't be in exchange for any sort of services or goods. There can't be a quid pro quo. And they do need to be made to a 501c3 charity, which most public charities that people are familiar with do qualify, but there are also resources out there. The first that comes to mind is Charity Navigator, which is a website that's easy to navigate, and just to confirm that where you're making a gift to is in fact tax deductible.
How is the deduction measured?
Yes, so like everything in the tax code, it's a little bit complicated. The first thing to understand that all gifts are deductible. The question is, will you actually obtain any tax benefit from making that gift? And that depends on several factors. The most important factor is whether or not you are a taxpayer who itemizes or uses the standard deduction. The standard deduction encompasses a variety of potentially deductible expenditures. Most commonly, it is charitable contributions, real estate tax and other state tax, mortgage interest, and also, for some people, medical expenses. And when those are all added together for a year, if they exceed the standard deduction, then the person will be getting a better tax benefit from taking those itemized deductions. And the charitable is a component of that. Yeah. Now, the standard deduction, for instance, in 2025 is $17,000 for a person under 65. It's a little higher if you're over 65. So if your charitable contributions are combined with your other potential deductions and they don't exceed $17,000, well, then you're not going to get any tax benefit from your charitable contributions because you're going to take the higher standard deduction anyway. But on the other hand, if you do exceed that total, when you add up all those deductions, the charitable contributions add to that, and as a deduction, they would offset your income, and as a result, you would have a lower income tax.
So outside of cash, what other means do taxpayers have of making a contribution?
So you'll find that charities will pretty much accept anything as a charitable contribution. The sky is the limit. Obviously, cash and in the form of cash and checks is the most common, but also very common would be to contribute securities, stocks and bonds and that sort of thing to a charity. That's very commonly done. There are some further tax advantages to making gifts that way, but somebody can also donate anything of personal property, so a vehicle, you'll hear about that pretty commonly, jewelry, art, even a house. Pretty much the sky is the limit.
Real estate in these days and age, we're hearing about digital currency more frequently, so some organizations have policies on accepting that.
That's true, and some organizations do have limits on what they will take, like not every organization really wants a painting from your house, but if it's something they can sell and they're willing to do that, then they'll accept the gift.
Are non-cash gifts treated differently than cash gifts?
So they are in some respects, and It's also important to note that a non-cash gift, whether it be securities or one of these type of tangible items we're talking about, do need to be valued, which can add some complication to the process. Marketable securities are easy to value, but some of those other types of gifts would require an appraisal perhaps. So there are some additional hoops that you might have to jump through if you're contributing something other than that.
What documentation does a donor need to keep of their contribution?
That's a great question, and it is very important to keep the proper documentation. So the IRS has a rule for smaller contributions, so cash and checks. There needs to be some sort of record, either a receipt in the case of cash or a copy of a canceled check would do the trick there. If a contribution is $250 or more, the charity has to provide you with a written acknowledgement letter that acknowledges the date of the gift, the amount of the gift, and they have to provide explicit language that you have not received any goods or services in exchange for your gift. Now, if the contribution, for instance, is to buy tickets for a gala dinner and you've received a dinner in exchange, that letter will specify that a certain amount or percentage of your gift was for goods, and that's fine, and you reduce the charitable contribution accordingly. And then for gifts that go over the $5,000 threshold, a qualified appraisal needs to be performed and kept in your records, and in some cases actually submitted to the IRS, but it's very important to keep that documentation and be able to substantiate that should the IRS inquire about your charitable contributions.
Donor-advised funds are getting a lot more attention these days. Can you tell us what a donor-advised fund is and why a taxpayer may want to consider one?
Sure. Donor-advised funds are becoming much more popular these days, and they are, for certain taxpayers, a terrific vehicle for charitable giving. Essentially what they are is a fund usually sponsored by a financial institution, something like a Schwab or Vanguard. Most of these big institutions have them. Community foundations are also, and maybe one of the originators of a donor-advised fund, and plenty of great community foundations operate donor-advised funds. And you can think of these funds as a charitable parking lot. So the fund itself is a 501c3. It's got the charitable designation, so anytime you transfer money to the fund, then it's deductible in that year of the gift against your taxable income. But you don't have to specify the charity that that money is going to right away. So it allows you to make a substantial contribution, maybe more than 1 year's worth of what you would normally give to an organization, all at once, park the money in the fund, and then the reason for the name is that you are the donor advisor, so you tell the fund manager where you would like that charitable money to go. There's usually a very easy mechanism for designating which charities you'd like to send that money to and when, which gives you a lot of control over a potentially larger contribution.
It's certainly a great tax planning strategy if you have abnormally high income in any 1 year for some reason.
That's precisely right, and that is where we often see those used, is when somebody's got some sort of higher income than usual. A large charitable contribution makes sense for tax that year, but perhaps they don't want to give it all to one or two charities at the same time. There are a couple of other benefits to donor-advised funds that are not tax related, but that are significant, I think, and maybe why we're seeing them become more popular. One is that it takes all the burden of the administrative record keeping off of you, because now the fund is who is making the contribution. They're the one who has to get the receipts, keep the receipts, make sure the charity is qualified. So you don't have to do any of that anymore, which is very nice. And the other, maybe a little bit of a vestige of the past, but clients of mine like it because they also don't get junk mail back from the charities once they've given once. They don't get all the reminders and the solicitations that generally come from making a contribution.
In July of 2025, a new tax bill was signed into effect. How does that new tax law affect charitable giving?
Well, it's very interesting because it took away a little and then it gave a little. So, like much of that tax law did. On the giving side, which I think is going to provide actually a terrific benefit for many taxpayers, when we spoke earlier about the itemized deductions versus the standard deduction, this new law kind of gets around that problem by allowing taxpayers up to $1,000 per person, so $2,000 for a couple filing jointly, to deduct their charitable contributions even if they are taking the standard deduction. So no longer is taking the standard deduction a deterrent or a disincentive for charitable giving. So that's a real bonus for charities and for taxpayers. For those taxpayers that are itemizing, there was a little bit of the reverse going on here, because now there is a floor on charitable giving, and the first 5% of your adjusted gross income is a floor on the amount that is deductible. So what I mean by that is if your adjusted gross income is $100,000, the first $500, the 0.5% of your income, is not deductible. So it does give a haircut to folks who are doing charitable giving in that way.
Thank you for sharing your knowledge with us today, Helene, on charitable giving.
My pleasure, Clarissa. And what is going to be your topic next week?
Well, it depends.